tell you what, here's what we're going to do. I wanted to give you guys some paperwork before you went in. I'm going to give it to you when you leave, okay, and then I want you to look over the information that I'm going to give you. And what the paperwork's going to look like is going to look similar to what we just went over right before lunch, okay? And what I did on that paperwork is I went through the same process that I went through with you right before lunch, okay? And so what'll happen is that when you come out of the building, I want you, Jason's going to be standing right over here, and just grab a sheet from him. He'll give it to you, and you can look over the information and then start maybe coming up with some questions or some things you want to ask a little bit later, and you'll be able to see where we're coming from when we bought this property. We own this property, and then Heartland Fund 1 owns that property across the road right there. Okay. Now remember, the main thing that we wanted to do is look at the math and make sure the numbers made sense. That's the very first thing, all right? And as you see when you get the numbers on this property, you're going to see the process we went through and ultimately why we decided that this was going to be one of the properties that we're going to buy, okay? So the numbers will speak for themselves, okay? Now let's talk a little bit about location. And like I said during the seminar, I don't mean to downplay location a little bit, but I want you to look at this from remember the word I think of when we look at buying them, what's the word I think of? Resale, right? It's resale. So here we are. We're about a block and a half from the busiest mall in eastern Iowa. Okay? We've got a nice residential area. We've got condominiums over here. We've got condominiums over there built as condominiums and owner-occupied. As I said, we've got the busiest mall about a block and a half away, as well as most of the nice restaurants. Grocery store, movie theater is another block, three, 4 blocks away. Okay? So, do you think we'd have a problem reselling this property if we need to? No. Okay? Now, as far as the condition of the property is concerned, remember we want to make sure we don't get into the process of spending a lot of money on the properties when we take over. All right? The minimum amount that we can do, unless it's warranted to spend a lot of money. We really did 2 things on this property when we took it over. One is, you can probably tell, is we painted the exterior. Okay? So we put some exterior paint on it. And the other thing we did is we painted the common areas. All right? We did a little bit of landscaping. Some bushes were pulled. As you see, we did some landscaping around here too to give it a nice appearance when people walk in. As far as, we want it to look good, of course, for the existing tenants because we want them to stay as long as possible. All right? And of course, for any future tenants that come in here and want to rent. We currently have 2 vacancies. I'm going to take you in one. We're going to go down there and we'll talk a little bit more once we get down into that apartment. So what I ask you to do is go in this door, go down the steps, and take a left. The apartment's open. So go ahead.
So he just rose it a quarter?
That's, yeah, just raised it a quarter.
Yeah. And there's still, yeah, that's
When you walk around, you're going to find that there's really nothing absolutely amazing about this unit, is there? Right? I mean, it's a typical 2-bedroom, a little over about 800 square foot apartment. Okay? Now, here are some key things that we did, though. When you look on your financial information, when we looked at it, we found out that the average rents in this building were a little bit under $500 a month. Okay? Now the rents are at $550 a month per unit. Okay? And as I said, our occupancy is very good. We got 2 vacant now. Unfortunately, one is because a guy passed away like 2 days ago. So 12 units. The other thing we did was we, not surprisingly, converted this into condominiums, right? So technically, this is really a condo you're standing in. And what that will do, as you'll see in your numbers, is that's reduced our property taxes by pretty close to 40% is what it will do. The other thing that we did with this building, and it's going to be a common theme in a lot of the other buildings that you see, that we're going to see today, and I'll open up the door. It's not anything to look at. It's just the washer and dryer facility. Okay. We went ahead and we just raised the dryer a quarter, and we raised the washer a quarter. All right. For that, this building, for not doing any other work than that, will gross an extra $500 to $600 a year because we just did that. Now remember, that's not much in terms of cash flow, but now we've added another $6,000 to $10,000 of value to the property just by doing that simple thing. Okay. So when we take a look at it, if you really start molding and combining all of these things together, right? You combine the numbers and the manipulation of the numbers together. You combine the property condition, which was in good shape when we took it over. You combine that with the location that we're in. This was a deal that we decided that we needed to do. Okay? The other thing I'll tell you is, from a management standpoint, properties like this are also easier to manage. Okay, so you have less problems with tenants, you have less turnover, thank goodness, right? But you have less, what I would call those nagging tenant problems of not paying rent on time. Discipline problems, I'll call them, being noisy, breaking rules, some cases breaking the law. Not that you don't have that in places like this, but the frequency is really, really low. And so once you can have your management running basically on autopilot like that, it makes it a heck of a lot easier too. Okay? The building across the street we own as well, and you guys will see that as you go out, and that's a Heartland Fund building, and we did the exact same thing with that building that we did with this one. Okay, the only difference is that's 15 units, okay, and not surprisingly, we did the same thing. We converted them into condominiums, raised the rent, etc. Okay, and once again, a big part of it is location and condition when we went in there. I think the only money we really spent on that building is we did paint that building too when we initially bought it, but that was it. Okay, so if you got any questions that you want to ask me, you got something you want to visit about, write those down, and when we get back to the hotel, we'll go ahead and we'll discuss those. Okay? I'll open up the laundry door. You guys can take a look as you walk through there. Once you go out, make sure Jason gives you a sheet of paper with the financial numbers on it, okay? Before you go, and then look those over as we go to the next property. All right? Watch it. Here we go. All right, we got everybody? Okay. Now, remember when we talked about, or what we've talked about so far, about making decisions on bad information? Okay? This is an example of making a decision on bad information. Okay? As you look at your numbers, you're going to find that they are not very impressive. Okay? At all. When this was originally purchased, the information that we had available, which was not accurate, but what we believed to be accurate, had the rents at the level and the expenses at the level that you see on one side of your page. Okay? On the other side of the page, that is what it has morphed into as we stand here today. Okay? As we stand here today, that's what it looks like. Okay? Now, I want you to take a look around. Tell me about the area. What do you think of the area compared to where we have been in the past? Okay, you don't need to say anything, but, okay, there's a noticeable difference, right? Look at the surrounding properties. Look at what's going on with those. Okay? Now, here's what we'll do. Apartment number 6 is open. I'd like everybody to go look at that apartment. You'll get an idea of pretty much what you can walk into if you're not doing your due diligence correctly. Okay? If you're not doing it correctly. All right? If you decide to skip some things, this is what can happen. All right? So everybody go ahead and go upstairs. It's the last unit on the right. It's open. Go ahead, walk in, walk through, and then come back downstairs and we'll meet in the lawn right out here.
Yeah. By far, but it's
Got more.
I keep having the question come up, and I'll let everybody know what happened here, Darin. How'd you get in? I had one guy ask me, "Did you buy it sight unseen? What'd you do here?" I had a client of mine that contacted me about buying this property. And when you've got a client, I basically took everything at what he told me, as far as the numbers, the expenses, everything else. I didn't bother checking into everything. I also had another gentleman that wanted to get into a property this size, and we basically decided this would be something he would do. if he would take care of the majority of the things that would need to be done. So we bought the property, basically not sight unseen, but we didn't verify anything. You can see the result. Okay. Now, it's not necessarily a bad property. Okay. The units are pretty good size, and the area is it's not quite the area that we've seen so far, but it's not actually terrible either. But it's definitely a downgrade area. Okay, from where we're at before. So from a resale standpoint, would we have a little bit more trouble reselling this one, or maybe say the first one we looked at? Right. Obviously this one. Okay. And when you look at your sheet, you're going to get an idea of really where the value of this property is now based on the cash flow. Okay, so if we wanted to sell this property right now based on the income stream and we wanted a cash producing offer or a cash producing sale, that's pretty much the ballpark of what we're looking at. Do you think this has operated very well so far? No. And what really led to that happening? Why am I standing here telling you that this is a problem today? What didn't I do? I did the math, but what didn't I do? I didn't verify anything. Okay, sure. Okay, you for years. Okay, whatever you say. I'm happy to help you out here. Dumb decision. Dumb decision. So now it's basically a game of we've got to hold on to this property for a long, long time until we can at least start getting close to that value back. Okay, which is not really what we wanted to do, but we really don't have much of a choice right now. We really don't. The other thing you notice, the condition of that unit. What'd you think of the condition of the unit? Probably not really good, right? This is something that you have more frequency with this kind of property in this kind of location. Okay, so this kind of stuff happens a lot more often. Okay, so obviously we're spending more time and more money on it versus the first property we took a look at. Okay, lesson learned, huh? All right, learn my lesson. Learn it.
Are we about 40 years old?
What's that?
Is it about 40 years old?
This was built in 68 or 69, so yeah, pretty close. Yep. All right, we'll see you at the next property. It's always interesting watching the residents look out their windows and walk by wondering what in the world is going on here. Because they're probably mad they're not out here. You know, they probably want to know what's going on. Last property we were at obviously presented some challenges to us. And obviously when I bought the property, and it gave you the reasons why we didn't do the due diligence and go through the process that we've talked about basically up to this point that we should have done. Okay? Here is the exact opposite of that. Okay? Here is a property where we did do everything right. We did take our time and go through the process of all of our due diligence, all of our number crunching, doing all of our analysis on all those income and expense items, and you've got that with you. And you get an idea exactly how profitable this property has been for us and is going to be. Okay? All we have really done with this property since taking over is we've painted it and we've replaced the garage doors. Okay? With the exception of doing that and maybe replacing some carpet in a few units that needed to be replaced, that's really about it. Okay, and as you can see, the value has jumped significantly since we've owned it. And we've owned it for less than a year. Okay, so now it's going to get significantly better because our taxes are going to go down even more because we're going to get our valuations lowered. All right, and we've got some vacancies coming up. My understanding is we're going to be renting those for $25 more per month than what we were getting previously. Okay, so everything is looking pretty darn good.
20 units at this price.
That's correct. So, we have a couple of units that are open. We'll start over there, go through that door right there, go in apartment number 1, walk through there. You can check that out. It's a 1-bedroom. When you're done, come on over here to this door, and you'll go through apartment number 10. Apartment number 10 over here.
Yeah, that is nice, brand new. It's efficient too, that way.
Still haven't cleared your kitchen, too.
All right, we've got one more property to look at, and it's a commercial property, and then we're going to head over to the hotel. So we'll see you guys at the next property. we're going to talk quite a bit tomorrow morning about single-tenant properties, and we're going to talk about what you need to look for and what you need to do to analyze those and how we go through our process. Sometimes you'll be looking at a situation where you're working either if it's yourself, maybe with one of your private investors that you've got working with, or maybe somebody has private money, where they're really looking for a consistent rate of return. Okay, especially someone, for example, just to kind of put them in a class. Usually it's someone that's older or retired, wants a consistent income stream coming in every single month, but also wants to get the benefits of owning some commercial real estate. All right, this is a really good example of this. This is a building that we own. It's 75,000 square feet, and this is one of Adidas' production facilities as far as their clothing wear is concerned. They do all of the silk screening here, printing, everything else, and the jerseys ship out of here. And then this is where it goes either to universities where they sell them from their bookstores or catalogs, clothing stores, etc. Okay? This provides us a 17% cash-on-cash return. That's what we get out of this property. This isn't so much a property that has large equity gains like we've talked about up to this point. It isn't a property that's really going to provide us huge jumps in value, but this is a property that is consistently performing day in and day out. Of course, it's under what's called the triple net lease, just like Earl May property we looked at, where the tenant takes care of all of the expenses. The only thing that we take care of is the roof and the structure, and the roof is under warranty for a long period of time. We still got another 12, 13 years for the roof warranty on this building, so we should be pretty good. Structure, steel structure, we're probably going to be fine, and we got a parking lot here that we are responsible for, but when it's concrete, there's really not too much to do there. Also, we like large corporate tenants. We can depend on the rent coming every single month. Okay, never been a problem with that. The other thing about corporate tenants like this is their lease is up here in about 3 years. Okay, their lease is up. We are already negotiating an extension of that lease right now. So we know we're going to have them at least another 5 to 7 years, possibly another 10 years is how long they're going to be here, at least for sure. All right, and guess what? Next year, we get a bump in the rent. Year after that, there's a little bump in the rent. So all of a sudden, within the next probably 3 years, this will be producing pretty close to a 20% cash-on-cash return to the owners, which is very, very nice. All right, now, we also have a pretty nice saleable property, too, for someone if they want to come in town and buy this. Location-wise, you notice, maybe you did, the interstate, we're really close to our hotel. We're only about not even a quarter mile from our hotel. Okay, so we're close to Interstate 380. Easy for these guys as businesses and trucks to get access in and out of here. And we're in a nice industrial area of Cedar Rapids. Easy access, easy traffic flow. It was really easy to get here too. Right, we'd have to go and wind through a whole bunch of streets. The other thing about this property is it is technically, this is going to come as a really big surprise, this is technically condominiums, commercial condominiums. So everywhere you see something coming outside, a little Quonset thing coming outside, that's basically technically another property. Right? So we really have 1, 2, 3, maybe I think we got 4 really condos that's really in this facility. So if and when they leave, if they do, of course it'd be nice to release the whole building, but now we can do it a piece at a time if we want to. Okay? Did we build this? No, we bought it existing. And as I said, this is a good example for if somebody's looking for not really a huge equity jump, but they want to own commercial property, they want a nice predictable cash flow coming in and month out, and of course this throws off some nice tax deductions as well.
How about your down payment on this?
The down payment on this was significant. I mean, this was a $3 million plus property is what we paid for it. So the down payment was significant, but folks were gladly willing to go in and put some money into this to get those kind of returns. One more.
Sorry.
Go ahead.
On $3 million, what's the down
20%.
payment?
Yeah. And so when you deal with, we'll talk more like I said tomorrow, when you deal with single tenant properties like this, when you have long-term leases in place, now this only has, like I said, a few years left and then an extension, right? But when you deal with those short-term leases, you should be expecting and getting higher returns on your money, okay? What you'll see with long-term leases, so if we had 25 years left to go on this lease, we probably would be getting a 7% cash-on-cash return on this, okay? Just because we're buying security, so to speak, security of that long-term income stream coming in, we're paying for that security with a lower return. But the key is to kind of combine both of those together so you can get a good property, a good tenant, and get a better return. All right? We'll see you guys back at the hotel.